Most people think they know exactly what causes inflation. They'll point to the government printing money and say the case is closed, but what if that explanation is too simple and maybe even a bit wrong? Look, we've all seen the charts linking money supply to prices. Honestly, the connection seems perfectly logical at first glance. So why do many economists get uneasy when you say printing money causes inflation? You see, money isn't just paper rolling off a press anymore. Modern money is often just digits created by banks with a few keystrokes. And those keystrokes don't automatically mean prices have to rise. Think about it. What happens to all that new money when it's created? Does it get evenly sprinkled into everyone's bank account? The reality is, it flows to specific places in the economy first. This means the effect on prices is incredibly uneven. Have you ever wondered why asset prices can skyrocket while other costs stay flat? That's a clue that the story is more about flow than amount. For a price to increase, someone has to actually spend that new money, and they have to spend it on a limited supply of goods or services. If new money just sits in a bank account, it's practically invisible to inflation. So the real trigger isn't creation, it's velocity, the speed money moves. But what determines that speed, that urgency to spend? Confidence plays a huge and often overlooked role. When people are worried about the future, they tend to hold on to cash, and during those times, even massive money creation might not budge prices much. Now, consider the opposite scenario, where confidence is suddenly high. Suddenly, that dormant money starts flying out of accounts. Businesses can't keep up with the surge in orders. They hit capacity limits for labor, materials, and shipping. This is where costs genuinely start to push prices upward. But is that really about the money or the strained system? Look at a supply chain shock, like a port blockage or a crop failure. That has nothing to do with printing money, yet it clearly causes inflation. It simply makes things harder and more expensive to produce. So we have two very different engines, demand pressure and supply scarcity. Often they get tangled together in the real world. And here's the curious part. Central banks only directly control one tiny lever. They influence the base rate for lending between big institutions. The rest of the money, the kind you and I use, is created by commercial banks. When a bank approves a mortgage, it essentially creates new money for that loan. So private lending decisions drive most of the money supply growth. Does that mean bankers, not governments, are the real inflation culprits? Not so fast, because they only lend when people and businesses want to borrow. It's a cycle of mutual belief about the future. If everyone believes prices will rise, they borrow and spend faster to beat it. That behavior itself becomes a self-fulfilling prophecy. Suddenly, expectations are the most powerful fuel of all, and expectations can ignite without a single new dollar being printed. Remember the 1970s, when inflation spiraled out of control? The money supply was growing, but the deeper cause was an entrenched belief. Workers demanded higher wages because they expected higher prices. Firms raised prices because they expected higher wage costs. This wage price spiral can keep going long after the initial shock. So breaking that cycle of expectation is the brutal task of central banks. They have to make money more expensive to borrow, slowing everything down. But that feels like treating a fever by causing a chill, doesn't it? The cure itself is painful and doesn't address the original complex cause. The next time you hear a simple story, ask what piece of the puzzle is missing. Let's be clear, governments can absolutely create money to fund their spending. But that act alone isn't a guaranteed ticket to higher consumer prices. Historically, there are periods where money supplies surged with no inflation at all. Japan's experience over recent decades is a perfect, quiet example. They ran massive monetary experiments, yet consumer price inflation stayed asleep. So where did all that new money go if not into everyday shopping carts? A huge portion flowed into financial assets and simply sat as reserves. This points to a broken link in the classic story we're told. You have to ask, what changed in the economy to let that happen? An aging population with less desire to spend is one powerful force. Globalized production kept a lid on the price of goods for years. What happens when those deflationary tailwinds start to fade, though? Suddenly, the same monetary policy can have a completely different effect. That's why timing and context aren't just details, they're the whole game. Look at the post-pandemic period, a fascinating natural experiment. Governments did spend heavily, and central banks created money. But were empty shelves and grounded ships really about that new money? Or were they about a world that physically couldn't produce and move stuff? The supply shock came first, pushing prices up aggressively. Only then did strong demand, fueled by savings and stimulus, meet that limited supply. Teasing apart the exact contribution of each factor is nearly impossible. But it shows that printing money was just one actor in a crowded play. Now consider a truly wild thought. Can inflation sometimes be a good thing? A little bit of expected inflation greases the wheels of the economy. It encourages spending and investment over hoarding cash under a mattress. The problem starts when that expectation gets unanchored and runs wild. And anchoring it requires a credible promise from monetary authorities. Do you trust them to control it, or have you lost faith in the system? Honestly, that trust is the invisible bedrock of stable prices. Once it's cracked, the job of restoring it becomes incredibly painful. They have to prove they're serious, often by causing a slowdown on purpose. This is the brutal theater of central banking. They're managing a story as much as they're managing interest rates. So if money printing isn't the sole cause, what should we be watching instead? Keep your eye on a few concrete things: supply chain, health, energy costs, and wage trends. Watch what people believe about tomorrow, because they'll act on it today. Listen for companies discussing their pricing power on earnings calls. Notice if rents are spiking due to a housing shortage. These are the real-time channels where price changes are born. Money is the medium, but these are the messages. The fuel can exist without a spark, and a spark can ignite without extra fuel. We focus so much on the fuel tank that we missed the matches. So the next headline, blaming the central bank's balance sheet, might be missing the point. The truth is, inflation is a symptom, not the disease itself. It's a fever signaling deep imbalances in supply, demand, and belief. To treat only the money supply is to treat only the thermometer reading, and that rarely fixes what's actually making the patient sick. Let's follow $1 of that so-called printed money and see where it gets stuck. It might land as a corporate subsidy for green energy, not a grocery store purchase. It could become a student loan, paying for tuition that rose for entirely different reasons. Or it might just park itself in a stock buyback, boosting a share price but not a product price. The destination determines the inflationary impact, not the origin. We often picture money as a uniform gas, filling the economic container evenly, but it's more like water, flowing through specific canals and pooling in particular basins. Some basins are deep and stagnant, while others overflow into the streets of the main economy. So which basins are overflowing right now? Look at housing again, a sector with a fundamental shortage of units. New money targeting that limited supply will almost certainly bid prices up. But does that mean we have too much money or too few houses? The policy answer changes completely depending on your reply. This is where the conversation gets uncomfortably political, doesn't it? Fixing a supply shortage is often harder than restricting money. It involves zoning, materials, labor, and long-term investment. Meanwhile, raising interest rates is a relatively simple, blunt lever to pull. But that lever works by crushing demand in the very basins that are overflowing. It makes mortgages expensive, cooling the housing market it helped overheat. See the circular dance here. Now, consider a world where technology is a powerful deflationary force. What if automation and AI start dramatically lowering the cost of producing things? Could that counteract other inflationary pressures for a time? It's a real possibility that further complicates the simple money story. Honestly, the textbook model of inflation is being quietly rewritten. New terms like greedflation or seller's inflation are entering the discussion. They point the finger at corporate pricing decisions in concentrated industries. When a few big players have the power to raise prices, and they all do, what happens? They can protect profit margins even as their own costs rise. This shifts more of the inflationary burden onto the consumer's shoulders. Is that about money supply or about market power? The data suggests it's a mix, but the mix matters for solutions. So if the causes are multifaceted, why does the printing money narrative persist? It's visceral, simple, and points to a clear villain we can all picture. A complex story about supply chains, expectations, and oligopolies isn't as satisfying. But the simpler story can lead us to the wrong medicine. We might tighten money when the real problem is a supply bottleneck, making it worse. Or we might ignore dangerous asset bubbles because consumer prices look calm. The stakes for getting this right are incredibly high for everyone's wallet. So the next time you hear the explanation, pause and listen for what's not being said. What other forces are at play in the room? The real story isn't found in a printing press, but in the messy human reactions to scarcity and fear. And that story is still being written, one economic decision at a time.